Leave it to you, the listener, to weigh the evidence and determine.
Provided we assume the flawless conversion of that backlog in provided we assume the flawless conversion of that
Technological supremacy of what CoreWeave offers once the facility $67 billion. Whether you see CoreWeave's means for our listeners because, well, it's the link.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
$72.99. That is exactly where CoreWeave is currently trading, establishing a market capitalization of roughly $38.8 billion. The recent trading volatility has been, frankly, unprecedented to witness. We are looking at massive volume and heavy selling pressure that drove the stock down more than 16% in a single session. This was entirely catalyzed by their lowered forward guidance right before the equity entered its current highly constrained consolidation channel, bouncing tightly between $70 and $85. It forces a critical examination of the underlying data. We have to ask, is CoreWeave's current valuation a profound discount for the definitive leader of the neo-cloud AI infrastructure market? Or is it a precarious, highly leveraged house of cards on the verge of buckling under the weight of unprecedented capital expenditures and operational delays? My position is that CoreWeave's nearly $67 billion contract backlog, its unparalleled technological symbiosis with NVIDIA, and its hyper-growth trajectory make this current valuation an asymmetric opportunity for long-term dominance.
And I look at that exact same setup, and I see a completely different reality. I would argue that CoreWeave's crushing capital expenditure requirements, their shrinking margins, the very real operational failures at key facilities, and a looming class action litigation present structural risks that the broader market is dangerously underestimating right now.
To truly understand the bullish thesis here, we really have to look at the sheer velocity of their execution, which I believe is completely decoupled from the recent price action we just outlined. Let's look at the top line. CoreWeave just reported 168% year-over-year revenue growth. They hit over $5.13 billion for fiscal year 2025.
Which is a historic number, I grant you that.
It makes them the fastest cloud service in the history of the industry to cross that $5 billion threshold. But as impressive as that is, the past is just prologue here. The actual foundational value lies in their take-or-pay backlog. We are looking at nearly $67 billion, 66.8 to be exact, in secured contracts. That is a fourfold increase in a single year. And we should probably unpack what take-or-pay actually means for our listeners because, well, it's the linchpin of the whole operation.
It absolutely is the linchpin. It means the customer agrees to pay for the server capacity whether they actually end up utilizing it or not.
Exactly. By structuring these contracts strictly as take-or-pay, CoreWeave has effectively taken the massive risk of GPU obsolescence, the fear that today's cutting-edge chip is tomorrow's paperweight, and transferred that risk entirely over to titans like Microsoft, Meta, and OpenAI. CoreWeave secures the hardware, but the hyperscalers bear the financial risk of utilizing it. And the reason these tech giants are willing to accept those terms is because of CoreWeave's undeniable competitive moat, their bare metal architecture.
Let me jump in there because the term bare metal gets thrown around a lot as a buzzword. When we talk about traditional hyperscalers like AWS or Google Cloud, they use virtualized environments. That means multiple virtual servers are sharing the same physical hardware, which is great for running millions of small, independent tasks like serving web pages, but it creates overhead.
Right. It creates a virtualization tax. AI workloads are highly parallelizable. They require thousands of chips talking to each other simultaneously to train a single model. Virtualization bogs that down. CoreWeave removes that layer entirely. They give the client direct, unimpeded access to the hardware. As a result, the data shows CoreWeave delivers AI training jobs roughly 35 times faster and at an 80% lower cost than a traditional cloud provider. When you combine that massive performance delta with nearly $67 billion in contractually secured future revenue, a stock price sitting comfortably under $80 looks like a severe market inefficiency to me.
That is a very compelling narrative, and the bare metal performance advantage is real. But I'm sorry, I just don't buy that the financial fundamentals support the valuation, especially when you methodically unpack their fourth quarter 2025 financial strain. The bear case becomes starkly apparent when you look past the top-line revenue. Yes, revenue is growing, but the bottom line is hemorrhaging cash.
Growth requires capital. That's the nature of infrastructure.
There is growth, and then there is a financial shock to the system. In Q4 alone, CoreWeave posted a net loss of $452 million. We are talking about nearly 90 cents per share in a single quarter. That figure didn't just miss Wall Street's consensus estimates, it nearly doubled them. And this was driven by a massive CapEx shock, with the company deploying over $8.2 billion in just 3 months. As a direct result of this spending velocity, their adjusted EBITDA margins are narrowing. They dropped from 64% in 2024 down to 60% in 2025.
A 4% margin compression during an unprecedented infrastructure build-out is hardly a structural failure.
It is when you pair those shrinking margins with their leverage. Their debt-to-equity ratio is resting precariously between 4.46 to nearly 8.94, depending on how you categorize some of their convertible notes. That is a hyper-leveraged balance sheet. And, perhaps most critically, and we cannot gloss over this, we have to address the immediate legal overhang. The Massive versus CoreWeave securities fraud class action is a very real threat. It centers entirely around the concealed delays at their Denton, Texas facility, and there is a crucial lead plaintiff deadline looming right around the corner on March 13th. I don't believe the market is mispricing CoreWeave. I think it is finally pricing in the structural execution risk.
I completely understand why you focus on the near-term capital expenditures and the debt load. It looks intimidating on a spreadsheet, but let me give you a different perspective on how that backlog essentially neutralizes the long-term risk. That $67 billion provides a level of revenue visibility that is almost unheard of in the technology sector. We aren't just seeing an increase in total contract value, we are seeing a structural lengthening of customer engagements.
Which means what, practically speaking?
It means the average contract duration has lengthened from 3 years to 5, and in several recent high-profile cases, 6 years. In the fast-moving world of AI, locking yourself into a 6-year infrastructure contract is a massive commitment. It proves that the foremost AI pioneers are genuinely desperate to secure CoreWeave-specific capacity. They are looking down the barrel of the transition to agentic AI systems that take action on your behalf, and they are building trillion-parameter models. They are locking in this bare metal infrastructure right now because they know a global shortage of high-tier data center capacity is an absolute inevitability. So the capital expenditure you characterize as a shock is simply the necessary upfront outlay to service guaranteed contractually obligated cash flows. You have to buy the servers to fulfill the lease.
That logic holds together perfectly, provided we assume the flawless conversion of that backlog into actual revenue. And that brings me to a central pillar of my argument. A backlog is purely theoretical until the physical infrastructure is actually built, powered, and operational. The source material clearly highlights the deep operational fractures occurring right now as CoreWeave attempts to scale at what is effectively the fastest rate in human history.
Building physical infrastructure is hard. No one is denying that.
But it's not just hard. It is breaking their internal timelines. Look specifically at that Denton, Texas cluster. This wasn't just any facility. This was a premier gigawatt-scale data center meant to service OpenAI. Yet we are seeing severe weather-related delays and major design revisions. The physical realities of building data centers at this scale. We're talking about managing extreme heat, securing massive power allocations from local utility grids, laying thousands of miles of fiber optics, are extraordinarily complex. You cannot simply wave a magic wand and turn a $67 billion spreadsheet entry into active, humming server capacity.
But weather delays and zoning revisions happen to every construction project on Earth.
True, but adding fuel to the fire, their planned merger with Core Scientific failed last October when shareholders rejected the deal. Core Scientific was supposed to be a critical building partner to help them navigate these exact physical hurdles, so they lost a key execution partner right when the scale got hardest. The fact that more than 10 different law firms have filed suits alleging the company actively concealed these Denton delays suggests that the execution risk is far higher than management's rosy projections imply.
That's an interesting point regarding the physical build-out, and the Core Scientific merger falling through certainly shifted their roadmap. But I would frame it differently. Delays in construction driven by anomalous weather patterns or local grid power allocations are standard friction points. They delay the timeline by a quarter or two, but they absolutely do not invalidate the underlying demand, nor do they diminish the technological supremacy of what CoreWeave offers once the facility's online.
Even if we grant that the facilities will eventually come online, they are just renting out hardware. Aren't they heavily exposed to hardware commoditization?
Let's address that head on, because it's a very common critique, the idea that CoreWeave is simply a landlord for chips, and therefore easily replaceable. I completely reject that notion. CoreWeave possesses a profound proprietary software moat that makes their hardware sing in a way others can't match. We really need to look at Mission Control, their central orchestration software.
Right, their observability stack.
Exactly. It provides full-stack observability from the bare metal hardware right up to the model layer. It utilizes something called GPU straggler detection in a massive AI training run with tens of thousands of GPUs. If one chip is underperforming or failing, it can hold up the entire job. Mission Control automatically identifies and isolates those straggler chips. The data shows this software alone reduces training interruptions by 50%.
Cutting interruptions in half is objectively impressive, I'll give you that.
And then you add Sunk to the mix. Sunk is their unified platform that allows researchers to use different orchestration tools, specifically Slurm and Kubernetes, on the exact same compute cluster. To use an analogy, think of it like a highly flexible factory floor that can instantly switch between building cars and building airplanes without having to stop and rebuild the entire assembly line. That software flexibility maximizes their productive GPU uptime to an astonishing 96%. On top of all that software integration, their exemplar cloud status with NVIDIA guarantees them early, priority access to the new Vera Rubin architecture rolling out in the second half of 2026. This isn't just about being a landlord. It's about a deep, symbiotic partnership that preserves a generational lead.
I acknowledge the software integration is highly sophisticated. Sunk and Mission Control are fantastic engineering achievements. But have you fully considered the intensifying competitive landscape? A software moat is only defensive if your competitors are standing still. And in this market, no one is standing still. Take Nebius, for example.
Nebius is definitely making aggressive moves.
The data shows Nebius is growing at a dramatically faster rate of over 532%. They are projected to hit a $7 to $9 billion run rate by the end of 2026. And they aren't just buying chips, they are building their own specialized software stacks and securing their own multi-billion-dollar contracts with the exact same hyperscalers CoreWeave is targeting.
But they are starting from a much smaller base, which inflates that percentage growth.
That's fair, but my broader point is about the business model itself. CoreWeave is a pure-play infrastructure bet. They only do one thing. That makes them hypersensitive to any minor dip in aggregate AI demand. Compare them to a vertically integrated legacy player like Oracle. Oracle is building massive AI data centers too, but they have a diversified enterprise software business that acts as a financial cushion against the capital intensity of buying GPUs. CoreWeave has no cushion.
They don't need a cushion if they have long-term contracts.
But what if the technology paradigm shifts? You mentioned the new Vera Rubin architecture from NVIDIA. If Rubin actually delivers the promised 10x inference cost reductions, the barrier to entry for training smaller, specialized models drops drastically. You might not need a massive, bare metal supercomputer to train a highly effective model in 2027. That potentially shifts the pricing leverage back to the buyers. CoreWeave's entire financial model requires them to maintain peak utilization just to service their massive debt load. They are highly exposed in any kind of cyclical downturn, regardless of how efficient Mission Control makes their servers.
I understand the concern about a cyclical downturn, but I am not convinced by that line of reasoning because it ignores the fundamental valuation disconnect currently present in the market. Let's step back and look at the capital structure and the valuation metrics objectively. At roughly $72.99 a share,
CoreWeave is trading at a price-to-sales multiple of just 6.2 times sales.
Which sounds reasonable until you factor in the debt.
But look at the comparative context. The broader U.S. technology sector average sits at 8.7 times sales. We are talking about a company that is projecting 140% revenue growth for 2026, yet it is trading at a significant discount to the broader tech sector average. That is a glaring anomaly. Furthermore, their approach to financing this massive expansion is strategically brilliant.
Strategically brilliant or recklessly complex?
Brilliant. To hit their goal of power capacity by the end of 2026, they needed capital. So they secured $8.5 billion in delayed draw term loans. But crucially, they didn't just borrow money on their own merit. They structured this specific facility to fund the infrastructure build-out exclusively from Meta platforms. By doing that, they effectively leveraged Meta's pristine investment-grade credit profile to significantly reduce the interest costs of the loan, perfectly offsetting CoreWeave's own lower junk credit rating. This is highly sophisticated asset-level financing. It insulates the broader corporate structure while capturing the upside of the build-out.
You point to the price-to-sales ratio, which focuses on revenue, but I strongly urge you to look at the price-to-book ratio, which focuses on the balance sheet, and that metric paints a much more alarming picture of their leverage. Right now, CoreWeave's price-to-book is sitting at 11 times. That is more than double the internet software industry's average, which is around 5.18 times book.
Because they are asset-heavy right now, in the middle of a build cycle.
Yes, but an 11 times multiple demonstrates a dangerously leveraged balance sheet with a severely limited equity cushion. If anything goes wrong, there's nothing to absorb the impact. You praise their strategic financing with the Meta deal, and yes, it's a clever financial mechanism, but the reality on the ground is that they are managing a staggering debt load. When you are looking at their forward capital expenditure guidance, which is between $30 and $35 billion for 2026 alone, there is absolutely no room for error.
But again, that expenditure is backed by the client contracts.
Assuming the physical build happens on time, which we've already established it often doesn't. This total lack of a safety net is exactly why analysts at Bernstein recently initiated an underperform rating on the stock, issuing a $56 price target. The margin for operational missteps is effectively zero. Think about the cascading effects. If there's another severe weather delay like we saw in Denton, or worse, if NVIDIA's delivery of the Vera Rubin chip slips by even one single quarter, CoreWeave cannot generate the revenue from that cluster. But the interest obligations on that multi-billion-dollar debt don't pause. They don't care about the weather or NVIDIA supply chain. The leverage works beautifully to amplify returns on the way up, but it acts as an absolute accelerant on the way down.
I see the mechanics of the bear case you're building. The execution risk is real. But as I synthesize these perspectives, my position remains firm. CoreWeave is simply navigating the necessary, albeit messy, growing pains of a company that is quite literally transitioning the global economy into the agentic AI era. You don't build the infrastructure for the next industrial revolution without taking on debt and dealing with construction delays. They are undeniably the premier bare metal provider, scaling faster than anyone else in cloud history. I believe the current sub-$75 price is a temporary misalignment driven entirely by short-term CapEx anxieties that completely fail to price in a clear contractually backed path to over $13 billion in 2026 revenue.
And my conclusion remains firmly grounded in the physical and financial realities of scaling that ecosystem. The historical revenue growth is undeniable, but the execution risks associated with building out at this unprecedented velocity are rapidly catching up to them. The widening net losses, the sheer magnitude of a $30+ billion capital expenditure roadmap for 2026, and the severe, unforgiving debt obligations make the current valuation highly precarious. We simply cannot ignore the litigation either. The allegations of concealed physical build delays speak to a potential breakdown in transparency during their most critical growth phase. A brilliant software moat won't save you if you default on your debt covenants.
2026 is going to be the ultimate proving ground. This is the year that AI infrastructure broadly must transition from theoretical capability and hype to proven measurable economic ROI for the broader market.
Absolutely. The build it and they will come phase is ending. Now it's the show me the returns phase, and the near-term catalysts are definitive and approaching fast. The upcoming Oracle earnings call on March 10 will provide crucial read-throughs on the broader infrastructure demand cycle. And then, just 3 days later, the March 13 lead plaintiff deadline for the CoreWeave litigation will force the broader market to finally assign a real mathematical probability to those structural and legal risks.
It is a fascinating inflection point for the company and the sector. Whether you see CoreWeave's backlog as the foundational bedrock of the AI revolution, or you view their massive debt load and fiscal execution risks as the blueprint for a highly leveraged house of cards, what's clear is that examining both sides gives us a much sharper picture of what's truly at stake. We leave it to you, the listener, to weigh the evidence and determine whether this equity represents a generational bargain or a cautionary tale.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!